Welcome to The Explainer. Today, we're going to tackle something huge: how you could potentially pay off your mortgage not in 30 years, but decades sooner. Let's get into it. So, let's be honest. Does it ever feel like your mortgage payments are just making the bank richer, not you? For a lot of us, the answer is a big, frustrating yes, especially in those first few years. But why is that? Let's peel back the layers. Okay, so let's set the stage with a really typical home loan. Imagine a $775,000 mortgage. It's a 30-year term, 5% APR. Pretty standard stuff, right? Well, if you just go with the flow and follow the bank's payment plan, you won't be free and clear until 2056. Wow. But here's the dirty little secret about traditional mortgages. They are designed to be front-loaded with interest. What does that mean? It means for the first several years, your hard-earned money is barely making a dent in what you actually owe. It's mostly just feeding the interest beast. And this chart, it lays it all out in black and white. Get this. After 4 years of payments, we're talking nearly $200,000 out of your pocket. Over $150,000 of that went straight to the bank as interest. You've only paid down your actual loan by less than 50 grand. That's just insane. You've paid 3 times more to the bank than you have toward your own house. So how do we fight back against this system? Well, it starts by looking at the whole financial picture. We need to follow the money and see where every dollar is going, especially that leftover cash. So let's zoom in on our example family. After they've paid everything, the mortgage, 2-car payments, credit cards, groceries, you name it, they're left with about $2,200 a month. That's their disposable income. Now, what does everybody tell you to do with that extra cash? Put it in savings, right? For an emergency fund. And that's not bad advice. But is it the smartest thing you can do with that money? Is it the most powerful move? Let's question that. Okay, this is where it gets really interesting. Look at the 2 options. You can stick that $2,200 in a savings account and earn what, $8? Or you can throw that same money at a high-interest debt, like a credit card, and save yourself $145 in interest you would have paid. It's not even a contest. You're getting a 16 times better result just by pointing your money in a different direction. And that right there, that's the whole foundation of this strategy. Think about it. Money you save on interest is just as good as money you earn in the stock market, except it's a guaranteed return. There's no risk. So that's great for credit cards, but how do we scale this up? How do we apply this powerful idea to the final boss of debt, the mortgage? All right, let me introduce you to the secret weapon in this whole plan. It's called a home equity line of credit, or a HELOC. Now, don't let the word credit scare you. It's not about taking on more debt. It's about unlocking and using the money, the equity that's already yours, trapped inside your house. Let's think about it like this. A regular mortgage, it's like a piggy bank with no hole in the bottom. You put money in, and it's just stuck in there, locked away. A HELOC is totally different. It's like a checking account. It's a flexible, revolving tool. You can take money out, put it back in, and take it out again. You're in control. Okay, so here's the game plan. It's a simple 5-step rinse and repeat cycle. Step 1, use the HELOC to grab some of your equity. Step 2, knock out your expensive debts. Step 3, make a big, chunky payment directly to your mortgage principal. Step 4, use your new, bigger cash flow to pay back the HELOC super fast. And step 5, you guessed it, do it all over again. So let's walk through it. Our family opens a HELOC and pulls out $50,000. Now, the first instinct might be to dump it all on the mortgage, right? Wrong. The first move, the smart move, is to take $12,000 of that and completely obliterate that high-interest credit card debt. Poof, gone. And boom, look what happens instantly. That $800 a month they were sending to the credit card company, it's now back in their pocket. Their cash flow jumps from about $2,200 to almost $3,000 a month. That extra money is now your financial superpower. Okay, now for the main event. We take the leftover $38,000 from the HELOC and we fire it like a cannon directly at the mortgage principal. And that one single move, it vaporizes over $118,000 in future interest, just like that. And it shaves more than 3 years off the loan in one afternoon. So we've made our big attack on the mortgage. Now it's time to reload. All of that supercharged cash flow, that nearly $3,000 a month, is now pointed directly at the HELOC balance. And you pay it down aggressively. In less than 18 months, it's paid off, and you're ready to start the next cycle.
And here's where the real magic happens, the snowball effect. You just keep repeating the cycle. Pull from the HELOC, smack the mortgage, pay down the HELOC. But wait, it gets better. Because while you're doing this, other debts, like those car loans, are naturally getting paid off. And that means your cash flow gets even bigger.
Check this out. A few years in, the car payments are gone. Suddenly, their available cash flow is almost $3,700 a month. So when they do the next $50,000 HELOC cycle, they can pay it back in just 14 months instead of 18. It's like a rocket booster. Every single cycle gets faster and more powerful than the one before it. So you repeat this cycle again and again and again. Where does it all lead? Let's look at the final scorecard. On one side, we have the old school 30-year slog. On the other, the results of this smarter strategy. Let's see who wins. And the results are just wow. A 30-year mortgage paid off completely in 11 years and 10 months. The amount of interest you saved on that mortgage, over $472,000. Now, of course, the HELOC isn't free. There's interest there too, about $29,000 over the entire time. But think about that trade.
This is the bottom line, right here. You are strategically spending about $29,000 in good short-term debt to completely eliminate over $472,000 in bad long-term debt. That's a net savings of more than $443,000. It's an incredible financial move.
So what this all comes down to is that financial freedom isn't always about getting a raise or finding a new job. Sometimes it's just about being smarter with the money you already have. It's about shifting your mindset from being a passive saver to being an active debt destroyer. And that simple shift could completely change the game for you and your family.